Canadian banks are randomly shutting down thousands of credit lines across the country, and the reason might surprise you. Welcome to the Daily Brief, Canadian Macro. It's March 17th, 2026, and I'm your host, Steve. Today we're covering Canada's banking system under stress, a major shift in rate cut expectations, and what's being called a 35-year high in youth unemployment. We heard from Market Mania on banking vulnerabilities and inflation pressures, Mark Mitchell on the Bank of Canada's changing outlook, and IceCap Asset Management on February's brutal jobs data. Let's start with what's happening in our banking system. Market Mania covered a story about Canada's banking system that reveals some serious cracks. Their main argument is that the system is fragmenting as banks struggle with bad loans, using Laurentian Bank as the prime example. Laurentian is being split up and sold off, with assets going to National Bank and private equity-owned Fairstone Bank at massive discounts. The numbers here are striking. Laurentian wrote down commercial loans by over $250 million and sold a $75 million loan portfolio to National Bank for just $25 million, a 67% discount. What's really interesting is the mortgage data they highlighted. Large mortgages over $850,000 now have a delinquency rate of 0.21%, up 162.5%, matching the default rates of mortgages under $200,000. This suggests wealthy borrowers in Toronto and Vancouver are defaulting at unprecedented rates. And this connects to the second major point about credit lines being closed. In a separate video, Market Mania brings up the issue of sudden closures of Canadian customers' lines of credit. BMO has confirmed that thousands of credit lines are being randomly shut down across Canada as banks tighten credit. Despite this, they're predicting inflation will surge again, pointing to gas prices hitting $2.03 per litre in some parts of Canada, and arguing that the recent 1.8% inflation reading is misleading due to sales tax relief base effects. Mark Mitchell, however, had a different take on where rates are headed. Focusing on how Canadian banks are completely reversing their rate predictions, Mark Mitchell's main point is that domestic economic data now supports rate cuts, but geopolitical tensions could derail them. The evidence cited was compelling. Canada's inflation dropped to 1.8% in February, with core measures falling to 2.3%, while the country lost 84,000 jobs in February and 100,000 over the last 2 months. CIBC explicitly reversed its 2027 rate hike prediction, doing a complete 180 from their January stance to now saying the data shifts towards rate cuts. What's interesting here is the bond market reaction he described. Mitchell shows that yields fell on the unemployment data Friday morning but shot right back up with oil price increases. 5-year Government of Canada bond yields, which dictate fixed mortgage rates, are now at their highest level since summer 2025. This sets up the job story that IceCap Asset Management dug into. IceCap Asset Management called February's jobs data one of the worst months ever, with 13 out of 16 sectors contracting. Their core argument is that mass immigration is creating a labor market crisis by flooding entry-level positions and crowding out young workers. The data they presented shows youth participation rates have fallen by 3%, which they note is massive for participation rates, leading to youth inactivity up 20% from 10-year averages. When adjusted for participation changes, IceCap argues youth unemployment is actually at a 35-year high. The mechanism they describe is straightforward. Canada's population growth jumped from 300,000 individuals to over 900,000 individuals annually through immigration, with newcomers concentrated in food service and retail, exactly where young people typically start their careers. They see this as confirming that Canada's GDP growth expectations of 1.2% are still too high and adds pressure for Bank of Canada rate cuts. What is fascinating is how these creators paint different but connecting pictures of Canada's economic stress. Market Mania suggests the banking system is under severe pressure from both commercial loans and credit issues, while Mark Mitchell shows how banks are reversing their rate predictions as domestic data weakens. IceCap Asset Management argues the job market in crisis is deeper than headline numbers suggest, particularly for young workers and those entering the job field. Both Market Mania and IceCap point to underlying economic weaknesses that should support rate cuts, but Market Mania warns inflation could surge again from energy shocks due to geopolitical circumstances. Mark Mitchell highlights how those geopolitical tensions are already pushing bond yields higher. IceCap concludes this confirms growth expectations are too optimistic and supports the case for cuts that Mitchell says banks are now predicting. Well, that's all for today's brief on Canadian macro. All credit goes out to the creators I featured today, and their original videos are linked in the description below, and I highly recommend checking them out for their full analysis. If you found this helpful, please subscribe, hit the notification bell so you don't miss tomorrow's brief, and don't be afraid to comment if there's another creator you think deserves a highlight here. I'm Steve. As always, nothing here is financial advice. Everyone's situation is different, so please do your own research and talk to a qualified advisor before making any financial decisions. Good night.